Do you ever wonder how the pros decide which stocks to buy and which ones not? It's not as simple as just looking at the trend of a stock price and seeing has it gone up or not over the last few years, or trying to predict just on the stock price. It's actually getting at the fundamental analysis of a company to decide whether or not that company is primed for long-term growth. In this video, we're going to go through some of the tips, some of the tricks, and some of the tools the pros use in a little crash course on business finance. Are you interested in learning more about finance, economics, and public policy? Click subscribe to see more content on these kinds of issues. So every company that has a stock releases 3 documents every year: the income statement, the balance sheet, and the statement of cash flows. These 3 financial statements give you an overview of the last year of what's going on with the company in terms of how much profit it's making, in terms of its debt, its assets, and whether or not the company is actually generating cash. We're going to talk a little bit briefly about each one of these, but first, where to find them. Yahoo Finance is a great resource, a free resource to be able to find information on pretty much any company that you want. If you go to Yahoo Finance, you can click on the Financials tab to get access to all 3 of these documents. So the income statement is the first of the 3 financial statements, and essentially what this statement does is it shows what has a company done over the past year. It's a flow document that basically shows the change from one year to the next. There are 2 really key metrics that you can find in the income statement. The first is called earnings before interest and taxes, or EBIT, and this is the total sales that a company makes, subtracting out their operating costs. This is a good metric to kind of look at: is the company making money from just doing what it does? Right? Its key operations, is it making more money on the sales than it's costing for them to make? Then the other key metric is net income, or the profit. It's the bottom line of the company. It's what you typically see reported in the news when a company releases its financials. The next document is called the balance sheet. And the balance sheet actually just shows the snapshot of a company's assets and liabilities on the day it was prepared, usually at the end of the year or the end of a quarter. So it's a little bit different from the income statement, which shows the change from one year to the next, or kind of the flow over the last year, where the balance sheet is just a snapshot at one point in time. Some of the 3 key metrics you're going to find on the balance sheet are assets, which tells you all the things that a company owns; liabilities, all the things that a company owes; and then equity, which is the amount of money that could be returned to the people that had invested in the company if all the assets were sold off and all the debt was paid off. A couple key things to think about with the end of the balance sheet is there are short-term assets and long-term assets. There's short-term debt and long-term debt. And it's important to kind of narrow down when you're looking at the balance sheet, what kind of debt does a company have, and does it actually have if it has a lot of short-term debt, does it have the short-term assets to be able to cover that debt? If it has a lot of long-term debt, does it have the long-term assets to be able to cover them? So we're not going to go really deep into the balance sheet, but this is just kind of an overview of what it is, and it's an important document, and the second one. The third document is called the statement of cash flows, and the statement of cash flows tracks the amount of cash that is coming in and out of a company over the course of a year. This is a really important document because what you'll see on the income statement and the balance sheet doesn't necessarily always deal with cash. It could be dealing with IOUs, it could be dealing with contracts as to where cash is going to be traded at a future date. And so it's really important to kind of understand, where is the cash, right? At the end of the day, if you don't have cash, then you're not going to be able to use that cash to spend it on things, to pay dividends. And so the statement of cash flows is really possible. There are 3 sections to the statement of cash flows: operating activities, investing activities, and financing activities. That operating activities section of the statement of cash flows might be one of the most important sections of all 3 financial statements. If you can go look at this section and the company is not generating cash from its activities, and that's a really big red flag for a company, right? A company should be able to generate cash from its activities. From whatever its core operations is, it should be able to generate cash. And if it's not, then that should be a red flag as to something else is going on that's making it so the company's not good at what it's supposed to be good at. The other 2 sections, the investing activities, looks at how much cash is being spent on new assets, how much, or maybe cash that's being made from selling off of assets. And then the financing activities section is looking at how much money is being borrowed or how much money is using to pay off debt. This is important because if a company is paying off its debt, then it may be spending a lot of cash, but it could be good. If a company is borrowing a lot of money, that also could be good, as long as it's borrowing it for productive reasons. Things that we can, you get into and we can get into in future videos, but these are just kind of an idea of what the statement of cash flows are. So once we understand the different financial statements and we can look at them, we want to know how can we actually really use them. Yes, the statements themselves have a lot of information on the company's financial health and well-being, but we can actually go one step further. And these are the tools that the pros use and that you can use to help make better investment decisions. And so we're going to talk about the use of financial ratios, the use of trend analysis and benchmarking, and then looking at something called beta. So again, Yahoo Finance, a great free resource. If you're at a company on Yahoo Finance, you can click on the Statistics tab, and you can bring up not all of these things, but quite a few of them. So first, let's talk about financial ratios. A financial ratio is a metric that we can use to analyze the recent performance of a specific stock. Now, it's important to remember that there is no one single ratio that is going to tell you everything, but we can use a whole host of them to kind of get a sense of what a company's performance is looking like. I'm going to give you an overview of a few key ratios. There are a lot more ratios. We're not going to go into how to calculate them. Some of them Yahoo Finance provides for you, some of them it does not. But if you want to learn how to calculate them, there's something that you can look up, but they are really important. So let's go through a few key ratios. One of the first ones is called the current ratio. This is a ratio that basically tells you whether or not a company has enough assets to be able to pay off its short-term debt. If the current ratio is 1 or higher, then a company typically has enough short-term assets to be able to pay off short-term debt. If it's less than 1, then that's a troubling sign that the company may be borrowing too much money to be able to cover its operations. The inventory turnover ratio measures how effective companies use its inventory. Right? It kind of tells you over the course of a year how many times is it cycling through the inventory. If a company has a really low inventory turnover ratio, then that means there's a lot of inventory that a company could have on hand. On the other hand, if it's a high inventory turnover ratio, then that might be a sign that it's effectively using its inventory. The net profit margin tells us the profit per dollar of sales. It tells us essentially what is, for each item that is sold, how much profit is being made. A few more metrics that are really important. The return on assets, ROA, is used to measure how well a company uses the assets it has to generate income. The return on equity measures how well a company uses the money gained from selling stocks, also from its retained earnings to generate income. Both of these two metrics are really important and of assessing a company's overall health. Two other metrics that are really important. One is earnings per share. And this indicates how much money a company makes for each share of stock issued. So it kind of tells us how well a company is using its stock, using its investments, and it's a really important metric for kind of understanding how successful a company is. And then the last is what we call the PE ratio, the price to earnings ratio, and this can be used to determine whether or not a stock is over or undervalued. A high PE ratio could indicate that a company might be overvalued, and a low PE ratio could indicate that a company is undervalued. Now, if we actually want to be able to really understand these things, how do we want to use these ratios? We can do them in two different ways. One is through what we call trend analysis, and it's used to take each one of these ratios and to track them over time for the same company. And if they're trending upward or if they're trending downward, it tells us something about the company for that specific metric. Benchmarking is where we take the metric for a specific company and then compare it to that of the industry average. Is this company doing better than everybody else in the industry? Is it doing worse? Or is it about the same? And it helps kind of get a sense of where an individual company lies relative to its key competitors. So using the two of these together, we can get a good sense of a company. And again, just to reiterate, no one metric or ratio can fully evaluate a company. We want to use multiple metrics, multiple ratios together to try to get a complete picture to see if a company is financially sound. This is what is called fundamental analysis, and it is how long-term solid investment decisions are made. They're not made on looking at a stock price and seeing has it been going up for the last few months, the last few quarters. It's not looking at what some famous person has said on Twitter. It is really diving down into the financial statements, calculating these metrics to actually determine whether or not a company is a sound fundamental company to invest your money in. One other tool that we can use when looking at stocks is called beta. Beta is a metric that tells how risky a specific stock is relative to the average risk of the entire market. Right? When we invest money in a stock, there's no guarantee that it's going to go up or go down. Right? And the stock market moves every single day, and all sorts of external forces influence it. But we can look at one specific company and determine, just based on that one stock, is it a very risky stock relative to the average stock market risk? Is it less risky? And so beta helps us do that. And again, Yahoo Finance will tell you what the beta is for a specific stock. If the beta is 1, then the stock is no more or less risky than the market. It has average risk. If beta is greater than 1, then the stock is riskier than the market. If the beta is less than 1, then the stock is less risky than the market. This is just one other tool to kind of help you understand as you're creating your portfolio of investments. Are you going to have a risky portfolio or a less risky portfolio? Just necessarily saying you're only going to invest in less risky or more risky stocks is really an individual preference, but it's not the end-all say-all. But this is just a tool to kind of help you, another tool that you can have to help you as you start making investment decisions. These are just some of the tools that the pros use. Finance and accounting are complicated, they're more in-depth, but if you're interested in learning more about them, subscribe to this channel. We will be talking about some of these issues more in depth. Thanks for watching. Hope this helps you in your investment decisions.